Before you take your next loan, swipe your credit card, or even think about buying a house, you need to understand this one invisible force that controls your entire financial life: interest rates. Welcome back. In today's video, we're breaking down how interest rates secretly control your money, your home, your job, and even your future wealth. Understanding how interest rates work is like learning the secret language of the global economy. Most people think of interest rates as just numbers, but in reality, they are one of the most powerful tools used by central banks. In the United States, the Federal Reserve controls this system. When rates go up, borrowing becomes expensive. When rates go down, money flows easily. This directly impacts your daily life, your loans, your credit cards, your expenses. On the other hand, low interest rates encourage spending and investment, but they can also create financial bubbles. When it comes to interest rates, one of the most powerful and immediate impacts is seen in the housing market. For most people, buying a home is not just a financial decision, it is an emotional milestone, a symbol of stability, and often the largest investment of their lifetime. However, what many fail to realize is that the affordability of that dream home is not only determined by its price, but by the interest rate attached to the mortgage. Even a small shift in interest rates can dramatically change the total cost of owning a home. For example, a 1 or 2% increase in mortgage rates might not sound like a big deal at first, but over the course of a 20 or 30-year loan, it can add tens or even hundreds of thousands of dollars in extra payments. This is why interest rates play such a crucial role in shaping the behavior of both buyers and sellers in the housing market. When interest rates are low, borrowing money becomes cheaper. This creates a surge in demand because more people can now afford to take out loans. First time buyers, young families, and even investors rush into the market to take advantage of these lower costs. As demand increases, property prices begin to rise. This often leads to intense competition, where buyers are willing to pay above the asking price just to secure a home. In such conditions, sellers hold the advantage, and the market becomes fast moving and highly competitive. However, this environment does not last forever. When inflation starts rising and the economy begins to overheat, central banks step in and increase interest rates to slow things down. As rates go up, borrowing becomes more expensive and monthly mortgage payments increase significantly. Suddenly, the same house that once seemed affordable is now out of reach for many buyers. This shift leads to a cooling effect in the housing market. Demand begins to fall as fewer people can qualify for loans or are willing to take on higher financial burdens. But here is where things become interesting. Even though demand decreases, home prices do not always drop immediately. This is because of what economists call the lock-in effect. The lock-in effect occurs when existing homeowners, who secured their mortgages at low interest rates, decide not to sell their homes. They are unwilling to give up their low monthly payments and take on a new mortgage at a much higher rate. As a result, the number of homes available for sale decreases. This limited supply can keep prices relatively high, even in a high interest rate environment. For first-time home buyers, this situation can be particularly frustrating. They are caught in a difficult position where both home prices and borrowing costs are high. Many are forced to delay their plans of homeownership and continue renting for longer periods. Speaking of renting, interest rates also have a strong indirect impact on the rental market. When fewer people can afford to buy homes, the demand for rental properties increases. Landlords take advantage of this increased demand by raising rents, which puts additional financial pressure on tenants. So even if you are not planning to buy a house, rising interest rates can still affect your cost of living. Another important aspect to consider is refinancing. When interest rates drop significantly, homeowners often refinance their mortgages to secure a lower rate, reducing their monthly payments or shortening their loan term. This can save a substantial amount of money over time. However, in a rising interest rate environment, refinancing becomes less attractive or even impossible. closing off a key financial opportunity for homeowners. Ultimately, understanding how interest rates influence the housing market is essential for making smart financial decisions. The true cost of a home is not just its listing price, it is the total amount you pay over time, including interest. By paying attention to interest rate trends, you can better decide when to enter the market, when to wait, and how to manage your long term financial commitments. In the end, timing, patience, and awareness are your greatest tools. The housing market is not just about buying property, it is about understanding the cost of money and using that knowledge to secure a stable and financially sound future. Interest rates are not just numbers that affect loans and mortgages. They are deeply connected to the health of businesses, the strength of the job market, and the overall direction of the economy. In many ways, interest rates quietly influence whether companies grow or shrink, whether jobs are created or lost, and whether people feel financially secure or uncertain about their future. To understand this connection, we need to look at how businesses operate. Almost every business, whether it is a small local shop or a large multinational corporation, relies on borrowed money at some point. Companies take loans to invest in new equipment, expand their operations, open new locations, or hire more employees. The cost of this borrowing depends directly on interest rates. When interest rates are low, borrowing becomes cheap. This creates an environment where businesses feel confident taking risks and investing in growth. A company might decide to launch a new product, expand into new markets, or hire additional staff because the cost of financing these decisions is relatively low. This leads to a strong and active job market where opportunities are abundant, unemployment is low, and wages often begin to rise. In such a scenario, employees benefit the most. With more job openings available, workers have greater bargaining power. They can negotiate better salaries, switch jobs more easily, and feel more secure in their financial future. This increased confidence leads to higher consumer spending, which further boosts business growth. It becomes a cycle of expansion where businesses and consumers both benefit from easy access to money. However, this period of rapid growth often leads to a major challenge: inflation. When businesses are expanding and people are spending more money, the demand for goods and services starts to exceed supply. As a result, prices begin to rise. Everyday expenses such as food, transportation, and housing become more expensive, reducing the purchasing power of consumers. To control this situation, central banks step in and raise interest rates. This is where the direction of the economy begins to change. As interest rates increase, borrowing becomes more expensive for businesses. Loans that were once affordable now carry higher costs, making expansion plans less attractive. In response, companies start to become more cautious. Instead of focusing on growth, they shift their attention to cost cutting and efficiency. Hiring slows down, expansion projects are delayed, and in some cases, businesses may even reduce their workforce to manage expenses. This is the cooling effect that central banks aim to achieve, but for workers, it often brings uncertainty. Employees may begin to notice fewer job opportunities, slower salary growth, and increased competition in the job market. In more severe situations, layoffs can occur, leaving individuals struggling to find new employment. This shift in the job market also affects consumer behavior. When people feel uncertain about their income, they naturally reduce their spending, which further slows down economic activity. Small businesses and entrepreneurs are particularly vulnerable in this environment. Unlike large corporations, they often have limited financial reserves and depend heavily on loans to operate. When interest rates rise, the cost of starting or maintaining a business increases significantly. Many aspiring entrepreneurs decide to delay their plans, which slows down innovation and reduces the creation of new jobs. The impact of interest rates also extends to financial markets. Companies that rely heavily on debt see their expenses increase as interest rates rise. This can reduce their profitability, leading to a decline in their stock prices. Since many individuals invest in the stock market through retirement accounts or savings plans, this directly affects their long term wealth. This creates a psychological effect as well. When people see their investments losing value or hear news about layoffs and economic slowdown, they begin to feel less financially secure. Even if their income has not changed, this feeling of uncertainty causes them to spend less and save more, which further contributes to the slowdown of the economy. In essence, interest rates act as a powerful control mechanism that influences the balance between growth and stability. When rates are low, the economy grows rapidly, but the risk of inflation increases. When rates are high, inflation is controlled, but economic growth slows down. Understanding this cycle allows you to better prepare for changes in the job market and business environment. It helps you recognize when opportunities are expanding and when caution is necessary. More importantly, it reminds you that economic conditions are always changing, and adapting to these changes is the key to long term financial stability. After understanding how interest rates affect your loans, your home, and even your job, the final and most important question is this: how do interest rates shape your personal wealth and your financial future? This is where everything comes together. Because at the end of the day, it's not just about understanding the system, it's about using that knowledge to make smarter decisions with your money. One of the most overlooked aspects of interest rates is how they reward or punish your financial habits. In a low interest rate environment, saving money often feels pointless. Traditional savings accounts offer very little return, sometimes barely enough to keep up with inflation. This pushes people towards spending or investing in riskier assets like stocks, real estate, or businesses in search of higher returns. While this can create opportunities, it also exposes individuals to greater financial risk. On the other hand, when interest rates rise, the entire dynamic changes. Suddenly, saving money becomes attractive again. Banks begin offering higher returns on savings accounts, fixed deposits, and other low risk financial products. For people who have built a habit of saving, this is a powerful advantage. Their money starts working for them without the need to take significant risks. This is especially important for retirees or individuals who rely on stable and predictable income streams.
However, high interest rates come with a trade off, and that is the cost of debt. Borrowing money becomes significantly more expensive. Credit cards, personal loans, and other forms of variable debt can quickly turn into financial burdens if not managed carefully. Interest charges begin to pile up, making it harder to pay off balances and easier to fall into a cycle of debt.
This is why managing your personal debt becomes critical in a high interest rate environment. Financial discipline is no longer optional, it becomes essential. Paying off high interest debt, especially credit card balances, should be a top priority. Every dollar saved on interest is a guaranteed return on your money. At the same time, understanding interest rate trends allows you to make smarter borrowing decisions. For example, if you expect interest rates to rise in the near future, it may be wise to lock in a fixed rate loan while rates are still relatively low. This protects you from future increases and gives you stability in your monthly payments. On the other hand, if you expect rates to fall, you might delay taking on large loans or financial commitments, waiting for more favorable conditions. Another key concept influenced by interest rates is opportunity cost, the idea of choosing one financial option over another. When interest rates are high, the safe option of saving money in a bank becomes more rewarding. This can make risky investments less attractive. But when rates are low, investors often move their money into stocks, real estate, or other assets in search of better returns. This constant shift of money across different asset classes is what drives financial markets. For long term financial planning, understanding these cycles is extremely powerful. The economy does not move in a straight line, it moves in cycles. Interest rates go up, then come down, and then rise again. Each phase creates different opportunities and different risks. People who understand these cycles are able to adjust their strategies accordingly rather than reacting too late. For example, during periods of high interest rates, a smart strategy might focus on saving, reducing debt, and preserving capital. During periods of low interest rates, the focus may shift toward investing, expanding income sources, and taking calculated risks. The key is flexibility, being able to adapt your financial decisions based on the environment around you. Ultimately, building wealth is not just about how much money you earn. It's about how well you manage and grow that money over time. Interest rates are one of the most powerful forces influencing that growth. They affect your returns, your costs, your risks, and your opportunities. As you move forward, remember this. You cannot control interest rates, but you can control how you respond to them. By staying informed, being disciplined, and thinking long term, you can turn these economic changes into advantages rather than obstacles. This is the difference between reacting to the economy and mastering it. And once you begin to see how these invisible forces shape your financial life, you are no longer just a participant in the system. You become someone who understands it, plans for it, and ultimately benefits from it. As you've seen throughout this video, interest rates are not just numbers. They quietly control your daily life, your financial decisions, and your future wealth. The difference between struggling financially and building real wealth often comes down to one thing: understanding how money actually works. If you found this video valuable, make sure to take action. Like this video to support more content like this. Subscribe to the channel Smart Money Moves for powerful financial insights. And turn on notifications so you never miss the strategies that can change your financial future. Because here on Smart Money Moves, we don't just talk about money,